October 29th, 1929. Black Thursday. The day Wall Street collapsed and triggered the most devastating economic crisis of the 20th century. 13 million Americans lost their jobs. Industrial production plummeted by 46%. Banks failed by the thousands. Fortunes evaporated overnight. The Great Depression reshaped the global economic order and left scars that lasted for decades. But here's what most people don't know. The crash didn't come out of nowhere. There were warnings, clear, undeniable patterns that economists, bankers, and even everyday investors could see if they looked closely enough. Yet those warnings were ignored, dismissed, or rationalized away by a market drunk on optimism and blinded by greed. And today, nearly a century later, those same patterns are emerging again. The warning signs of 1929 aren't just historical curiosities locked away in dusty economics textbooks. They're flashing red across global markets right now in 2025, pointing toward a potential catastrophe in 2026 that could rival or even exceed the devastation of the Great Depression. To understand why 2026 could become the next 1929, we need to go back to the roots of what actually caused the collapse. Most narratives focus on the crash itself, the dramatic plunge of stock prices, the panic on the trading floor, the suicides of ruined speculators. But the crash was merely a symptom. The disease had been spreading through the American economy for years before anyone noticed the fever. It began in the early 1920s, a period Americans called the Roaring Twenties. World War I had ended, Europe lay in ruins, but America emerged as the world's dominant economic power. Industrial production soared. New technologies electrified the nation, literally and figuratively. Automobiles, radios, refrigerators, and washing machines transformed American life. Consumer culture exploded. Credit became widely available for the first time, allowing ordinary Americans to buy goods they couldn't afford outright. Stock ownership spread beyond the wealthy elite to the middle class. By 1929, nearly 10 million Americans owned stocks, many purchasing them on margin, meaning they borrowed money to invest, putting down as little as 10% of the stock's value and borrowing the rest. This created a dangerous feedback loop. Rising stock prices attracted more investors. More investors pushed prices higher. Higher prices attracted even more investors. The market became detached from economic fundamentals. Companies with mediocre earnings saw their stock prices triple or quadruple. Speculation replaced investment. People weren't buying stocks because they believed in a company's long-term prospects. They were buying because they expected prices to keep rising indefinitely. This is called the greater fool theory. You might be a fool for paying an inflated price, but there will always be a greater fool willing to pay even more. The problem is, eventually you run out of fools. By September 1929, the stock market had reached absurd valuations. The price-to-earnings ratio of the average stock was over 30, far above historical norms. Margin debt, the money borrowed to buy stocks, had reached unprecedented levels. Nearly $9 billion had been loaned out for stock purchases, equivalent to roughly half the entire value of the New York Stock Exchange. This meant that any significant decline in stock prices would trigger massive margin calls, forcing investors to either put up more cash or sell their stocks, which would drive prices down further, triggering more margin calls, creating a death spiral. But there were other less discussed warning signs that made the situation even more precarious. Income inequality had reached extreme levels. The wealthiest 1% of Americans controlled nearly 40% of the nation's wealth. Meanwhile, farmers struggled with falling crop prices and crushing debt. Industrial workers saw their wages stagnate even as productivity soared. This created a consumption crisis. The economy's growth depended on consumer spending, but the majority of Americans lacked the purchasing power to sustain that growth. Credit temporarily masked this problem, allowing people to spend money they didn't have, but debt can only substitute for income for so long. When consumers maxed out their credit and couldn't borrow anymore, demand collapsed. Another critical factor was the weakness of the banking system. In 1929, America had over 25,000 banks, most of them small, undercapitalized, and fragile. They weren't regulated like today's banks. There was no Federal Deposit Insurance Corporation to protect depositors. When banks failed, depositors lost everything. And banks were heavily invested in the stock market, both directly and through loans to speculators. When the market crashed, banks collapsed by the thousands,
destroying the savings of millions and freezing the flow of credit that businesses needed to operate. Then there was the international dimension. The global economy in the late 1920s was built on a fragile foundation. European nations were still recovering from World War I, burdened by enormous debts and reparations. Germany, forced to pay crippling reparations to the Allies, could only do so by borrowing from American banks. Britain and France used those reparations payments to repay their war debts to America. The entire system depended on continuous flows of American credit. When the U.S. stock market crashed and American banks stopped lending abroad, this circular flow broke down. European economies collapsed. International trade plummeted. The crisis that began on Wall Street metastasized into a global depression. And perhaps most ominously, there was the psychological factor, the absolute conviction that the good times would last forever. Irving Fisher, one of America's most respected economists, famously declared just days before the crash that stock prices had reached what looks like a permanently high plateau. Business leaders, politicians, and financial experts assured the public that the American economy had entered a new era where the old rules no longer applied. Technology and modern management techniques had supposedly eliminated the boom-bust cycle. This wasn't just optimism, it was delusion. A collective refusal to see the obvious warning signs, because acknowledging them would mean confronting uncomfortable truths about the sustainability of the prosperity everyone was enjoying.
With even more devastating potential consequences. Start with valuations. As of late 2025, major stock indices have reached levels that make the 1929 bubble look modest by comparison. The S&P 500's price-to-earnings ratio has hovered above 30 for extended periods, matching or exceeding the peak valuations of 1929. Technology stocks, particularly those involved in artificial intelligence, have seen their valuations disconnect entirely from earnings or even revenue. Companies that have never turned a profit trade at market capitalizations in the hundreds of billions. The justification is always the same. This time is different. We're in a new era. AI will transform everything. Traditional valuation metrics don't apply. These are almost word-for-word echoes of what people said in the 1920s about radio, automobiles, and electrification. The technology was real then, just as AI is real now, but reality doesn't justify infinite valuations. Every transformative technology in history has eventually faced a reckoning between hype and actual economic value. The dot-com bubble of 2000 should have taught us this lesson. Apparently, it didn't. Leverage has returned with a vengeance. Margin debt in the U.S. stock market reached record levels in 2021, and after a brief decline has been climbing again. But margin debt is just the visible part of the iceberg. The real leverage in the system is far more extensive and far more hidden. Private equity firms have loaded companies with unprecedented levels of debt to finance acquisitions. Corporate debt as a percentage of GDP has reached all-time highs. Governments, particularly the United States, are running trillion-dollar deficits even during periods of economic growth, something that would have been unthinkable in previous eras. Household debt has climbed back to levels not seen since the 2008 financial crisis. And then there's the shadow banking system, the complex web of hedge funds, money market funds, and other non-bank financial institutions that operate outside traditional regulatory frameworks, but are deeply interconnected with the entire financial system. These institutions use derivatives, repurchase agreements, and other sophisticated instruments to create leverage on top of leverage. The exact amount of leverage in the shadow banking system is impossible to measure because much of it is opaque even to regulators, but estimates suggest it could be several times larger than the traditional banking system. This is the financial equivalent of a skyscraper built on quicksand. Income inequality has reached levels that exceed even those of 1929. In the United States, the top 1% now controls more than 30% of all wealth, while the bottom 50% holds less than 2%. Real wages for the median worker have barely budged in decades when adjusted for inflation, despite massive increases in productivity. The wealth generated by economic growth has flowed almost entirely to the top. This creates the same consumption crisis that plagued the 1920s. Consumer spending drives roughly 70% of the U.S. economy, but how can consumer spending remain strong when the majority of consumers are treading water financially? Once again, debt has been the answer. Credit cards, auto loans, student loans, and mortgages have allowed Americans to maintain a middle-class lifestyle even as their actual economic position deteriorates. But this strategy has limits. Student loan debt alone has surpassed $1.7 trillion. Auto loan delinquencies are rising. Credit card debt has hit record highs. Sooner or later, the credit runs out, and when it does, consumer spending will collapse, taking the economy down with it. The banking system, despite the regulations put in place after 2008, remains far more fragile than most people realize. The failure of Silicon Valley Bank and several other regional banks in early 2023 exposed cracks in the foundation. These weren't isolated incidents caused by unique mismanagement. They were symptoms of broader vulnerabilities.
Banks are heavily exposed to commercial real estate, a sector facing a crisis as remote work has permanently reduced demand for office space. Property values are declining and many commercial mortgages are underwater. Banks are also sitting on massive unrealized losses in their bond portfolios, a consequence of the Federal Reserve's rapid interest rate increases. When interest rates rise, the value of existing bonds falls. Banks don't have to recognize these losses on their balance sheets as long as they hold the bonds to maturity. But if depositors start withdrawing money en masse, banks will be forced to sell those bonds at a loss, potentially triggering insolvency. The Federal Reserve and the FDIC have provided backstops, but these are temporary measures, not solutions to the underlying problems. And just like in 1929, banks are interconnected. The failure of one institution can trigger a cascade of failures throughout the system. The international situation mirrors the instability of the late 1920s. Global debt has exploded to over $300 trillion, more than 3 times global GDP. Emerging markets are particularly vulnerable, having borrowed heavily in dollars. When the dollar strengthens, as it has in recent years, their debt burdens become unbearable. Several countries are teetering on the edge of default or have already defaulted. China, the world's second-largest economy, is facing a real estate crisis that could dwarf the U.S. housing crash of 2008. Chinese property developers have defaulted on hundreds of billions of dollars in debt. The property sector accounts for roughly 30% of China's economy. If it collapses completely, the ripple effects will be global. Europe is struggling with energy crises, inflation, and political instability. The European Union's banking system remains weak, with many banks still carrying bad loans from the last financial crisis. And the global trading system, which has been a pillar of economic growth for decades, is fracturing. Geopolitical tensions between the United States and China, the war in Ukraine, and the rise of protectionist policies are disrupting supply chains and reducing international commerce. When global trade collapses, as it did in the 1930s, economic downturns become depressions.
Perhaps the most dangerous parallel between 1929 and today isn't found in the numbers or the structural vulnerabilities. It's psychological. It's the collective belief that we've somehow transcended the old economic rules, that central banks have become so sophisticated they can prevent any serious downturn, that technology has fundamentally altered the nature of economic cycles. This belief isn't just wrong. It's the same delusion that blinded people in 1929, and it's what makes the coming crisis inevitable. When everyone believes disaster is impossible, that's precisely when disaster becomes most likely. The Federal Reserve and other central banks have spent the last 15 years engaging in unprecedented monetary experiments. After the 2008 financial crisis, they slashed interest rates to zero and began buying trillions of dollars worth of bonds through quantitative easing. These policies were supposed to be temporary emergency measures. Instead, they became permanent features of the financial landscape. Interest rates remained near zero for over a decade. Central bank balance sheets exploded from less than $1 trillion to nearly $9 trillion at their peak. This created a massive distortion in financial markets. With interest rates at zero, investors were forced to take on more and more risk to generate any return. Money flooded into stocks, real estate, cryptocurrencies, and other speculative assets. Asset prices became detached from underlying economic reality. They were no longer reflecting the productive capacity of the economy. They were reflecting the amount of money central banks were printing. When the Federal Reserve finally began raising rates in 2022 to combat inflation, markets initially panicked, then stabilized. But the problem hasn't been solved. It's been deferred. Central banks are now trapped. If they keep rates high to control inflation, they risk triggering a debt crisis and a recession. If they cut rates to support growth, they risk reigniting inflation and further inflating asset bubbles. There's no good option, only a choice between different flavors of disaster. The faith in central banks' ability to manage the economy is misplaced for a fundamental reason. Central banks can't create real wealth. They can only manipulate the money supply and interest rates. In doing so, they can encourage or discourage borrowing and spending, but they can't fix underlying structural problems. They can't eliminate debt. They can't resolve income inequality. They can't force consumers to spend money they don't have. They can't prevent banks from failing when their assets turn worthless. They can't stop global trade from collapsing when geopolitical tensions rise. All they can do is buy time, and they've been buying time for 15 years. The bill is coming due. In 1929, there was no Federal Reserve safety net in the modern sense. The Fed existed but didn't understand its role as a lender of last resort. Today, the Fed is much more proactive, but it's operating in an environment that's far more complex and far more leveraged. The tools that worked to contain the 2008 crisis may not work next time. The system is fragile. The debt levels are higher. The political will to bail out banks and corporations is weaker. And the Fed's own balance sheet is already bloated. How much more can they buy before the currency itself loses credibility? Technology has created entirely new vulnerabilities that didn't exist in 1929.
High-frequency trading algorithms now execute millions of transactions per second, dominating market activity. These algorithms are designed to profit from tiny price movements, and they operate faster than any human can react. When markets become volatile, these algorithms can amplify the volatility, creating flash crashes where billions of dollars in value evaporate in minutes. In 2010, the Dow Jones Industrial Average dropped nearly 1,000 points in a matter of minutes before recovering, an event caused largely by algorithmic trading. Similar incidents have occurred repeatedly since then. Now imagine what happens when a real crisis hits and these algorithms all try to sell at the same time. The speed and scale of a modern market crash could make 1929 look like a slow-motion event. Then there are cryptocurrencies, a multi-trillion-dollar asset class that barely existed a decade ago. Crypto markets are almost entirely unregulated, rife with fraud, manipulation, and speculation. Billions of dollars have been lost in exchange collapses, rug pulls, and hacks. Yet millions of people have poured their savings into these digital tokens, believing they represent the future of finance. When the crypto bubble bursts, and it will, the losses will cascade through the financial system, destroying retirement accounts, pension funds, and investment portfolios. Social media has created an environment where financial manias can spread faster and farther than ever before. In the 1920s, stock tips spread through word of mouth, newspapers, and radio. Today, a single tweet or Reddit post can trigger buying frenzies involving millions of people within hours. The GameStop saga of 2021 demonstrated how social media can coordinate retail investors to drive stock prices to absurd levels, completely disconnected from any rational valuation. While that particular episode ended without systemic consequences, it revealed a new dynamic in financial markets. Crowds of amateur investors, fueled by online communities and a sense of rebellion against the establishment, can create massive volatility and unpredictability. This democratization of investing sounds positive in theory, but in practice, it means millions of inexperienced people are gambling with money they can't afford to lose, often using leverage, often following advice from anonymous strangers online. When the market turns, these investors will panic and sell en masse, accelerating the crash. The same technology that allowed them to pile into the market will facilitate their stampede out of it. The political environment adds another layer of instability. In 1929, the initial response to the crash was inadequate. President Hoover believed the economy would self-correct and resisted aggressive government intervention. By the time Franklin Roosevelt took office in 1933 and implemented the New Deal, the damage was already catastrophic. Today, political polarization in the United States and other major democracies has reached levels not seen in generations. Gridlock prevents meaningful policy responses to emerging crises. When the next financial catastrophe hits, will governments be able to mount a coordinated response? Or will they be paralyzed by partisan warfare, conspiracy theories, and populist backlash against bailouts? The political appetite for rescuing banks and corporations has diminished significantly since 2008. Ordinary citizens watched as trillions of dollars went to safe financial institutions while they lost their homes, jobs, and savings. That resentment hasn't disappeared. It's intensified. Any attempt to use public money to stabilize the financial system in the next crisis will face fierce opposition. This could turn a financial crisis into a political crisis, which could then spiral into a constitutional crisis. The social fabric that holds democratic societies together becomes strained when economic suffering is widespread and prolonged.
So what does all this mean for 2026? Why is that year specifically being identified as a potential inflection point? The answer lies in the convergence of multiple cyclical and structural factors that are all reaching critical mass simultaneously. Economic cycles don't follow precise calendars, but they do follow patterns. And when you map out the trajectories of debt accumulation, asset price inflation, monetary policy shifts, and geopolitical tensions, they all point toward a window of maximum vulnerability in late 2025 and throughout 2026. This isn't prophecy, it's pattern recognition based on historical precedent and current data. The credit cycle is reaching exhaustion. Since the 2008 crisis, the global economy has been sustained by an unprecedented expansion of debt. Governments, corporations, and households have borrowed at record levels, enabled by artificially low interest rates. But debt accumulation can't continue indefinitely. Eventually, borrowers reach the point where they can't service their existing obligations, let alone take on new debt. We're approaching that point now. Corporate debt refinancing will become a major issue in 2025 and 2026, as companies that borrowed cheaply during the zero-interest rate era face the need to roll over their debt at much higher rates. Many won't be able to afford the new interest payments. Default rates will spike. Companies will cut costs, lay off workers, and reduce investment. This will ripple through the economy, reducing consumer spending and triggering more defaults. The same dynamic will play out in commercial real estate, where property owners who finance their purchases with cheap debt will find themselves unable to refinance as values decline and rates remain elevated. Banks holding these loans will face mounting losses. Some will fail. The survivors will tighten lending standards, choking off credit to businesses and consumers, accelerating the economic contraction. The stock market bubble will pop. Exactly when is impossible to predict with precision, but the longer valuations remain detached from fundamentals, the more violent the eventual correction will be. And unlike 1929, when the crash was largely confined to the United States before spreading globally, a crash today would be instantly global. Markets are interconnected through electronic trading systems. A panic in New York triggers selling in London, Tokyo, Hong Kong, and Frankfurt within seconds. Trillions of dollars in wealth could evaporate in days. Retirement accounts that took decades to build would be decimated. The psychological impact would be profound. Consumer confidence, already fragile, would collapse. People would stop spending on anything beyond essentials. Businesses would see revenues plummet and would respond with mass layoffs. Unemployment would soar. The economy would enter a self-reinforcing downward spiral, where job losses lead to reduced spending, which leads to more job losses, which leads to even less spending. This is how recessions turn into depressions. The geopolitical dimension makes everything worse. The relative peace and stability of the post-Cold War era is over. We're entering a new era of great power competition, with the United States and China locked in an increasingly confrontational relationship. Taiwan remains a flashpoint that could trigger military conflict. The war in Ukraine has demonstrated that major powers are willing to engage in proxy conflicts with potentially catastrophic consequences. Economic sanctions, export controls, and tariffs are being weaponized as tools of geopolitical competition. This fragmentation of the global economy is extremely dangerous. In the 1930s, the collapse of international trade turned a severe recession into a decade-long depression. Countries erected tariff walls, devalued their currencies, and pursued beggar-thy-neighbor policies that destroyed the cooperative framework necessary for global prosperity. We're seeing the early stages of that same dynamic today. Supply chains that were built on the assumption of peaceful global integration are being ripped apart. Companies are being forced to choose sides between American and Chinese markets. The efficiency gains from globalization are being reversed. This increases costs, reduces productivity, and shrinks the economic pie that everyone is fighting over. In a fragmented, hostile international environment, financial crises spread faster and are harder to contain because countries are less willing to cooperate on solutions. Climate change adds an entirely new dimension of risk that didn't exist in 1929. Extreme weather events are becoming more frequent and more severe, causing billions of dollars in damage annually. Agricultural productivity is being disrupted by droughts, floods, and temperature extremes. Insurance companies are withdrawing from high-risk markets, leaving property owners unprotected. Coastal cities face the prospect of rising sea levels, making vast amounts of real estate uninhabitable. The economic costs of climate change are already substantial and will accelerate dramatically in the coming years. This creates a slow-burning crisis that compounds all the other vulnerabilities in the system. A financial crisis that might have been manageable in isolation becomes catastrophic when it occurs against the backdrop of climate-driven disruptions to agriculture, infrastructure, and human migration. Governments and societies will be forced to allocate resources to climate adaptation and disaster response, precisely when their fiscal capacity is most constrained by economic collapse. The combination could overwhelm institutional capacity to respond effectively. The warning that no one talks about is this: we've constructed a global economic system that is fundamentally unsustainable, held together by debt, monetary manipulation, and collective delusion. The same forces that caused the 1929 crash have reasserted themselves, magnified by technology, globalization, and the sheer scale of modern finance. The signs are all there for anyone willing to look. Extreme valuations, massive leverage, widening inequality, fragile banks, geopolitical instability, political dysfunction, and most dangerously, the absolute conviction among most people that nothing bad can happen, that central banks will always step in, that the system is resilient enough to absorb any shock. That conviction is wrong. The system isn't resilient, it's brittle. It's been pushed to the breaking point, and the next major shock, whether it comes from a debt crisis, a geopolitical conflict, a climate disaster, or some combination of factors, will shatter it. History doesn't repeat exactly, but it rhymes with haunting precision. In 1929, people ignored the warnings until it was too late. They believed the prosperity would last forever. They trusted that the experts and authorities had everything under control. They learned, too late, that bubbles always burst, that debts always come due, that gravity always wins. We're making the same mistakes now. The crash of 1929 led to a decade of misery, political extremism, and ultimately global war. The crash that's coming in 2026 could be even worse because the global economy is more interconnected, more leveraged, and more fragile than it was in 1929. The weapons of mass destruction that exist today didn't exist then. The climate crisis didn't exist then. The speed at which information and panic spread didn't exist then. When the system breaks this time, the consequences could reshape human civilization for generations. The warning is clear. The question is whether anyone will listen, or whether we'll repeat the mistakes of 1929 and pay an even steeper price for our collective blindness. The clock is ticking. The patterns are unmistakable, and 2026 is closer than anyone wants to admit.